The housing market has gone crazy and policymakers are about to react. But are they going to fix the real problem? Here's what they may do and how it might affect you. What's up everyone, Conrad Neufeld here, and today we're going to talk about 14 different things that policymakers in Canada may do to try to cool the housing market. But before we get into that, let's talk about one thing that's already been announced, and that's OSFI's raise in the qualifying rate for uninsured borrowers. So what does that actually mean? Well, it means that for those Canadian homebuyers that are looking to put more than 20% down and skip out on these CMHC insurance premiums, it means they'll now have to qualify at a higher rate. So yes, now when you put down a larger down payment, you end up with not only a higher interest rate, but you now also qualify for less. Currently, when you try to qualify for a mortgage in Canada, you have to demonstrate that you'd be able to support the mortgage payments based on an interest rate of 4.79%. That's known as the qualifying rate. This is already well above what most Canadians are getting for the most common type of mortgage, which is the 5-year fixed. But apparently OSFI, which is the Office of the Superintendent of Financial Institutions, decided that this could be higher. Now, a lot of people, including the media, believe that this is aimed at cooling the housing market. But it isn't really. For starters, OSFI does regulate most, but not all of the financial institutions out there providing a mortgage. So this change only affects those banks and mortgage lenders under its supervision. And secondly, this change arguably only affects the most qualified borrowers, those with a more significant down payment, and only by about 4 to 5%. It makes some great headlines, yay, something's being done. But that's mostly it. Now that being said, there are some changes that haven't been announced yet that may happen later within the year, maybe even in time for our long-awaited budget. So what may happen? Well, the most likely is we may see a reduction in the maximum debt service ratios. We've already seen a few changes with this in the past few years, so for them to reduce it even further wouldn't be a hard sell. This would mean that all Canadians that have less than a 20% down payment would simply qualify for less. And even though this is most likely out of all the things to happen, I don't think it's a great idea for two reasons. To start off with, the real issue here is supply, not demand, and it's been that way for a few years. Imagine we were all on an island. There's a group of us. And while we have some food, we know that there's not going to be enough food in the long term, at least for everyone. So there's some members of the group that suddenly decide, you know what, we should explore this island. We should try to find more food sources so that everyone can eat. And the leader hears this, but instead says, you know what, that's a great plan, but what we're actually going to do instead is we're going to kill a bunch of people off, and that way there's just less mouths to feed, and our current supply should be just fine. And then to make it easier for us to decide who we're going to kill, we're just going to pick the poorest of us, and that's who it'll be. Now that kind of seems like a dramatic analogy, but that's also kind of in line with the housing policy mentality of the last few years. We've got all of these people who want to buy houses, and rather than taking meaningful actions to increase that supply, to satisfy that hunger, we would rather just remove people from the equation. Our policies are designed to remove home buyers from the equation, even though they may end up in a situation where they end up paying a higher rent than the mortgage payment that they would have had to been able to afford. Which is the second reason I don't like this policy. I think it disproportionately affects the poor. If this policy is put into place, the rich are going to be just fine. It's the lower end of the income spectrum that are going to struggle the most. The second thing that may happen is there may be some new housing creation initiatives. This would be a great thing. This is the root cause of our current problem that's only been exacerbated, not caused, by a pandemic. Now, there's no word yet on what those initiatives would look like or even when they'd be rolled out, but hopefully it's got a lot more teeth than the fluff they rolled out when it came to the first-time homebuyers incentive. The third thing we may see is higher minimum credit scores required for mortgage applications. If rolled out, honestly, this will have very little impact on the stability of the market and have little to no effect on the housing prices as well. I mean, it has been demonstrated throughout history that Canadians do not want to miss their mortgage payments. In fact, if you stack it up against car loans, visas, lines of credit, or any other types of debt, Canadians will miss payments on those other types of debts long before they even think of missing a payment on their mortgage. So raising the credit score may limit some foreclosures in the event that things go bad, but likely not enough to notice. There are also already some analysts saying there is a chance that the Bank of Canada may raise the rates. This is a complete 180-degree turn from what some of these analysts were saying only a month ago, that the Bank of Canada was truly going to hold their interest rate until 2023. Now, I think these analysts are wrong. I don't think it's going to go up to the short term, but I also don't think it's going to wait until 2023 to go up either. And if you want to know more about why that is, you can watch my video on this. I'll put the link in the description in the video below. You may also see an elimination of unsecured down payments. A lot of people don't know that it's still possible to purchase your first home using an entirely borrowed down payment. You can go get a loan or a line of credit for the purposes of your down payment. Now, not everyone qualifies for this because you do need a higher credit score, but more importantly, the loan that you go to take out actually reduces your pre-qualification amount because it increases your total debt load. You need enough income to support not only your new mortgage, but the loan that you just took out. Now, do I think that if regulators choose to do this, that this will have a significant impact? Once again, no, likely not. For starters, it's a very small percentage of the population that is currently borrowing their down payment to purchase their new home. And even if it was a large number of people doing it, there'd be way too many loopholes to get around this regulation. For instance, when getting a mortgage, one of the things that's required is demonstrating a 90-day history of your down payment, showing the trail of it for 90 days. So if someone was patient enough, or had to because of a brand new regulation, there'd be nothing to stop them from taking out a loan or a line of credit, putting it into their savings account, waiting 90 days, and then presenting that as their down payment. And lenders would legitimately see that as an own saved down payment. Another thing that you might see is that the minimum down payment may see an increase to 10%. This was being thrown around a few years ago and seems to have made its way back into the discussions. But I'll say this though, even though there are some analysts that are saying that this has a higher chance of happening than some of the other items that we've mentioned on this list, it still wouldn't make a whole lot of sense for regulators to institute this regulation change. Most of the places that are having high run-ups in prices are in markets that already traditionally have larger down payments of more than 10%. After all, it's not the people who are barely scraping by that are driving up the home prices. So this change would have very little impact on those areas. And given that under our current mortgage regulations, when buying a home more than $500,000, you already need to put 10% down on the balance above the $500,000 mark, this really only makes buying a home under $500,000 tougher. We may also see an increase in the minimum down payment needed to avoid default insurance. Right now, if you want to avoid the default insurance premiums, also known as the CMHC fees or Sagen fees or Canada Guarantee fees, Canadians would have to put 20% down. What they're thinking of doing though is bumping that up to 25% down. Now, I don't think that this is a bad idea per se. I just shake my head at it. Years ago, it was considered too risky to insure some of these non-high ratio loans. And now, in a time when the market's seen as more risky than ever before, suddenly the insurer wants to start insuring some of these loans again? Are these risky to insure or are they not? The next three things that are possible are directly aimed at real estate investors. We could see tighter rental financing guidelines like restricted borrowed down payments, so that could be no borrowing against one property to buy another. We could see an elimination of the interest deductibility for real estate investors. So right now, when you pay interest on a mortgage and non-mortgage loans that have been used for real estate investing, that's all tax deductible. So if this happens, that could have some pretty negative tax implications for leveraged real estate investors. We may also see a speculation tax on shorter term property holds. This would be aimed at trying to avoid having people buy properties simply to try to sell them off shortly after while the market is going up. But that would be a stupid financial practice, so you shouldn't need a tax to try to dissuade you from doing that anyway. But you can consider this a type of property flip tax, because if this comes into play, then those that are doing property flips will not only have to pay capital gains tax when liquidating their investment, but they'll also have to pay this new speculation tax on top of that because they'll have owned the home for less than a year. On the one hand, it may seem like a good thing because it might limit these property flippers from buying properties that are low value, dumping a bunch of capital into them, and then turning them into a higher valued asset, thereby reducing the supply that's available for first-time home buyers at these lower price points. But truly, most of the properties that these home flippers are acquiring shouldn't be bought by first-time home buyers anyway. There are a ton of unknowns when you're a first-time home buyer and a lot of costs that some people just don't anticipate. So to buy a home that also requires a substantial amount of capital expenditures simply to bring up to a livable standard is likely not a good purchase for your first-time home. Another something policymakers may do is institute a new foreign buyer tax. And I get it. For years, some markets in Canada have vilified immigrants as the reason why home prices have risen to an unfathomable level. Yet the last couple of years have seen some of the fastest growing home prices during a time of reduced immigration. From a financial perspective, Canada is in need of immigration. We want people to be attracted to Canada, to plant roots here through things like home ownership. Canada's poor financial planning is what got us into this, not immigrants. So we need to stop looking at taxation as a solution for poor planning. We want to encourage more immigration to our country, not dissuade them by taxing them for our mistakes. Something that is being considered, however, that I am in favor of, is the prohibition of blind bidding, meaning you actually have to go see the property before locking it up under contract. And while I like this regulation in concept, I think actually bringing it into fruition would have a ton of problems that would just make it impractical. It would be very difficult to bring this out in a meaningful and fair way, and as a result, that's why I don't think it'll actually see the light of day. Part of me kind of laughs when thinking about this though, because I just imagine this amazing race style of car ride with a bunch of homeowners all trying to get to the home first so they could put their bid in. It'd be stupid, maybe even dangerous. Not only that, there is a growing number of the population that is buying entirely online, particularly migrants, people who are buying from one part of the country and moving to another part of the country, and immigrants, because they physically can't be there to see the property for themselves. So I just can't see how a policy like this could be rolled out with unfairly targeting these Canadian migrants and Canadian immigrants. Number 13, you may see policymakers force 30-year amortizations to qualify at 25 years. 30-year amortizations were already removed years ago for insured purchases, but for those purchasing putting more than 20% down, some lenders still offer 30 and even 35-year amortizations. And so while a policy like this would be built more for the stabilization of housing prices, it actually won't have a whole lot of impact either, because most lenders that offer these 30 and 35-year amortizations already have this rule in place where they'll qualify people based on the lower amortization of 25 years and the lower pre-qualification that comes with that. This would just make an even playing field for these lenders, requiring all of them to amortize over the 25 years. And last, but definitely not least, there's been discussion of removing the principal residence tax exemption. And honestly, I hate the fact that it's even being talked about, so I'm going to give it the least amount of attention possible. When you sell your home, that equity is your money, earned from years and years of mortgage payments that was paid for with income that was already taxed through income tax. So whether you're a homeowner or you have yet to be a homeowner, no one has anything to gain from this except a government with a spending problem. Now, thankfully, I don't think that this is actually seriously being considered at this point, and it's important that we as Canadians keep it that way.